Hello and welcome to the week ahead webinar with me, Fiona Cincotta. I'm just going to give it a few moments for a few more people to join and then we will crack on. Okay, so thank you very much for joining me. I'm Fiona Cincotta, as I mentioned, Senior Market Analyst here at City Index. And what we're going to be doing today is looking ahead to the main market events occurring next week and which markets to be watching and perhaps what's going on in those markets and how you can trade these events. So without further ado, I'm just going to ask you to read the risk warning. Obviously, if you do have any questions at any point in this webinar, then please do pop them through the system, but I'm just going to be quiet now to give you a moment to read through the risk warning. Okay, so first of all, we'll just start with having a look at the economic calendar. This is the economic calendar here at City Index. You might recognize it from our webpage. I've just obviously filtered it for the week ahead and also for the high impacting releases. So just literally as we start through the week, we're a relatively quiet day on Monday. Then we will be looking to UK data on Tuesday. This is going to be UK employment change, unemployment rate. There'll also be wage growth data, which no doubt will be watched closely by the Bank of England. I'm just going to push us forward because not only have we got UK labour market data very much in focus. There's also, we've got UK inflation data, and that's due in on the Wednesday. And then on the Friday, we've got UK retail sales. So plenty of data to be getting, to be creating volatility potentially in the pound US dollar, pound crosses, and also the FTSE. Now, as far as the state of the UK labour market is so far, it has actually been holding up pretty well. It's been relatively resilient given the strength or given the aggressive rate hikes that we've seen from the Bank of England. Unemployment has been just ticking slightly higher. Also, we had some industry data out from the REC, which said that the number of British employers advertising jobs in December fell by 32% year on year. So that also gives us some clues that perhaps there is some signs of weakening in the labour market. Wage growth at the moment in the UK is still pretty strong at around just over 7%. So actually some weakening in the labour market probably won't be, might even be welcomed by the Bank of England, as that would mean that wage growth pressures ease as well, which just takes off that inflationary pressure off. Now, just moving on to inflation data, we're expecting, well, UK inflation data, I'm just going to show you here, has been steadily cooling. Core inflation is expected to cool further. inflation headline CPI actually had its largest downside surprise since 2021 for the November reading. So, and we can see if we just have a look at this chart, we can see over the last couple of months there have been relatively large downside surprises as far as inflation is concerned, compared to the upside surprises that were perhaps a little bit more prevalent at the beginning of the year. Now, as I said, inflation is expected to cool. Headline inflation cooled to 3.9% in November. What we have seen, though, in Europe and in the US yesterday is that headline inflation has just ticked higher in December. So we've seen that both the Eurozone inflation ticked up from 2.4% to 2.9%, and yesterday in the US we saw inflation ticked up from 3.1% to 3.4%, whilst core inflation continues to fall. So I think what that's showing us is that, you know, whilst inflation is still on the trajectory downwards, it's going to be a bumpy road, and we have heard the central bankers warn us of this, that perhaps, you know, this final bit to get to that 2% target could be a little bit harder than the sort of relatively sharp falls in inflation that we've seen so far. The inflation data is going to be key for setting Bank of England rate cut expectations. What we have seen is that the market has reined in rate cut expectations after getting really quite ahead of itself at the end of last year. At the end of last year, we saw the market was pricing in 5 times 25 basis point cuts by the Bank of England. Now, we've had Bank of England Governor Andrew Bailey sounding relatively hawkish still, saying it's still far too early to talk about cutting interest rates. I mean, to a degree, with inflation still double the Bank of England's target, then yes. But if we do see another big downside surprise on inflation, that's going to see the market bring forward those rate cut bets, which could put some pressure on the pound. As well as inflation data next week, I mentioned we've got retail sales. Now, this week we had BRC, the British Retail Consortium retail sales data out, and it showed lackluster sales over that key Christmas period. So I guess this doesn't necessarily bode well for retail sales data from the ONS, which could come in slightly weaker. We did see a push up in last month. That was thanks to those Black Friday sales, but I'm not sure we'll necessarily be seeing a repeat of that this month. Again, you know, if you're looking for retail sales, they're weaker than expected. That's going to raise concerns over the health of the UK consumer, as you know, the cost of living crisis, as high interest rates and still relatively high inflation keep households squeezed. Now, just whilst we're on this, I'm going to be pull up some charts now. Let's just have a look at the GBP USD and what's going on there. So here we go. This is the chart for sterling US dollar, the daily chart. Now we can see we've had these lows that they were hit at the beginning of January. That's around the 120. They were around the 126.20 level, but actually the price has been guided higher. It's been guided higher quite nicely by the 20 SMA. Buyers are going to want to try and break over that 110 psychological, the 128 level. That's what they're going to be looking for. But I'm just going to point out here, we've got a couple of longer wicks there on these candles, which suggests that there wasn't much buying interest at those higher levels. Now that could be taken, especially when sort of looking at the declining momentum in the RSI, as a sign that the pair might struggle to push above that 128 level. Now, if we get stronger than expected inflation, that could help bolster the sterling US dollar above that level. If we get weaker retail sales and a weaker labour market, then we might see a testing of that 20 SMA. That's a minor support around the 127.10. A break below here is going to bring this level back into focus, the 126.10. And below here comes the 200 SMA. And this is something we're going to see in quite a few of the charts. We've got sort of, the 20 SMA guiding the price higher, and then we've got a potential breakdown to the 200 SMA should things deteriorate in the outlook for sterling. Other one just to look for as far as the UK is concerned is obviously the FTSE. So the FTSE here, we can see it's had, it's still trading above this rising trend line that's been in place since the end of November. But it ran into resistance here at that 77 sort of 80 level and has been falling away relatively aggressively actually until here, and it's found some support on that 200 SMA. Yesterday, this was when we got that US inflation data out. It's attempting a rebound today, but again, we've got that relatively long wick that I've talked about before, which suggests that demand isn't so strong at the upper levels. So what we're going to be looking for from the FTSE, buyers are going to want to see a break above this level, the 76.30. That was last week's low. If we can get a close above there, that's going to be an encouraging sign, and we'll take the next move towards the 20 SMA. However, failure to rise above that level is going to see the focus shift back to the 200 SMA there at 75.75, with a break below there, sort of opening the door to that 75.50 level. Okay, so right, getting back to the economic calendar, moving through the days, we've got so yeah, on Tuesday there isn't, to be honest, there isn't that much high impacting data from Europe out. We do have this the CPI for Germany, but this is the second reading. So we wouldn't expect it to be as market moving as the preliminary reading. It should just be a reconfirmation that the CPI headed higher. We've also got the inflation data from Canada. Next one I'm going to focus on though is going to be China. So we've got a lot of data out from China, really important data here. We've got retail sales, and we've got GDP, and we've got industrial production. So let me just take you back to here. Bear with me. Okay, China's GDP. We've got Q4 GDP, and I think it's expected to slip slightly. We did have an upside surprise in Q3 where the economy grew faster than expected at 4.9%. And we're looking for a full year target of around 5%. That's what the market is going to be focusing on. As far as China's economy is concerned right now, I think it's really giving out some mixed signals. We had inflation data out today. Yes, there was deflation. Deflation fell inflation fell year on year, but by less than expected. And on a monthly basis, it increased after falling last month. So it increased 0.1% after falling 0.5% last month. So there are some signs that maybe there's some stabilizing in the economy. Also, we had Chinese trade data, and exports were also stronger than expected. Again, another encouraging sign for the Chinese economy. But let's not forget, there is a whole world of issues that they're facing there in China, most prominent being the property sector, the retail estate squeeze, or slump, should I say, rather than squeeze. It's slumped. And also, you know, the economic recovery, post-COVID economic recovery, never really materialized last year. We've also had the World Bank lowering their GDP forecast for China in 2024. But as I said, as well as GDP data, we've also got industrial production and retail sales. Retail sales has been an interesting one to watch because it has actually been coming in quite strong. It grew 10% last month, 10% year on year in the latest reading, which I think was November. No, it was October. Which is a real, no, sorry, it was November, which is a really strong reading, but that's because it's a really favourable comparison. If we think back to what was happening in November 2022, they were all in lockdown. So retail sales have really come on very strongly because no one was shopping at the end of 2022. So it's quite difficult to take a sensible read out of that data because of the favourable comparisons, but obviously that's going to start coming out as we move into January readings and February readings when the economy had reopened. So I think, you know, it's still worth keeping an eye on retail sales. It's still, you know, the whole sort of China consumption story is one that is not as strong as it has been, and there are concerns for it. Also, industrial production is going to be another one. This chart we can see, you know, retail sales and industrial production have been falling broadly, I would say, since the start of 2023, which doesn't necessarily bode well for the GDP outlook either. So as far as the markets are concerned, with this one, we're going to be having a look here at the Aussie dollar, US dollar. This is an interesting one. Obviously, the Aussie dollar being, or the Australia being China's, China is Australia's major trading partner, so it really does reflect quite nicely the impact of what's going on in China. Also, Australia is a big miner as well, and what goes on in China affects metal prices. So what we can see is since, I mean, across 2023, this was trending lower. We had the Aussie dollar falling against the US dollar. We had that turnaround then when we saw, you know, the market start to really get excited about a dovish Fed pivot. However, ran into resistance, as we're seeing with a lot of things, ran into resistance around at 68.7, 68.50, and has since fallen down really quite aggressively again below that 20 SMA, finding support there really nicely on that falling trend line. And that's also created this level here of 66.45, which is the January low. So that's going to be a level that we'll be watching out for. We see the RSI is just tipping down below that 50 level. So yeah, I'll be looking for a move below 66.45 to get a lower low, and be interesting to see how it reacts here, which is that falling trend line, and sort of also the that'll be the 50 SMA there. On the upside, again, we're seeing, look, those relatively long trade candle wicks, which does suggest again that demand hasn't been that strong at these upper levels, but any sort of recovery is going to need to get back over that 20 SMA around the 67.45 level in order to look towards 68. Right, so what else have we got going on? We've done UK inflation, we've done the China data. Obviously, that Australian data, that does in fact as well tie in with the Aussie US dollar that we've been looking at. And then, of course, there's US retail sales and the Michigan sentiment index for January. Again, let's have a look at retail sales. It's holding up pretty well. What can I say? 0.3% month on month. That's not bad at all. Just bear with me, let's get there. Here we go, retail sales. They have been holding up. I mean, if we have a look out across the last couple of months, yeah, we had a dip lower here in October, but back growing in November, expected to rise again in December, but that makes sense. You know, we've got the US jobs market is proving to be relatively resilient. Yes, you've got interest rates at a 22-year high, but a lot of America's on 30-year mortgages anyways, not necessarily affecting those people that have bought homes, you know, who've already in their homes and not getting new mortgages. And also, you've got inflation, which has been cooling, although it has, as I said, just ticked up this month, in fact. So, you know, there is a reason that US retail sales are managing to show this resilience. They also add into that narrative of the US economy heading for a soft landing in 2024. Let's just have a look at the markets and what this might mean for those. I think one that I've been looking at a lot recently, US dollar, Japanese yen. Here we go. So this has been a good reflection here. You know, you've got that optimism surrounding a Fed pivot and also a potential Bank of Japan dovish, sorry, a Bank of Japan hawkish pivot. And then you've got the terrible news of the earthquake in Japan at New Year, which rebuilding efforts combined with stimulus measures means that perhaps the Bank of Japan is less likely to adopt a hawkish stance sooner rather than later. Also got the market paring back those Federal Reserve aggressive rate cut bets, which has helped the pair extend its rally from this low of 140.25 back above the 200 SMA and looking there to test resistance where it failed. It was base rejection there at the 20 SMA. The 20, sorry, that's the 50 there at 146.50. That's also the high from this week. So we've seen a pullback down from that high. Broadly speaking, I would say, you know, we're still in a relatively bullish trend, a short-term trend there. We do need to see a rise above this level. I'm a little bit concerned about that long upper wick, which suggests, as I said, that demand wasn't that great up there. Obviously, this is the first level that sellers are going to need to break down. That's the 145 level. That's also the June high. Going to break down there. You're exposing the 200 SMA once again. That could, obviously, we need that to hold in order for the buyers to remain or to have any sort of control. I'm going to just have a look at the euro US dollar anyway. As I said, there isn't a massive amount of data out as far as the Eurozone is concerned, but it's an interesting chart anyway. It's that we've seen this level here pretty much hold at the 108.90. Again, it's tracking that 20 SMA higher. It's just on the lower side of it. Buyers really need to get a grip above that level of 109.80 in order to bring that 110.20 level into focus. That's going to be a key focus for buyers in order to extend gains towards the 110.60 and 111. On the downside, you know, if that 108.90 and the 108.80, which was actually the January low, if they break, then that's going to expose that 200 SMA there at the 108.40 level. Just as far as stocks are concerned, obviously it's US earnings season, kicks off today with the banks. Also next week, you've got a couple more banks. You've got Goldman Sachs on Tuesday. You've also got Morgan Stanley on Tuesday, as well as several other names. You don't have tech stocks yet. They haven't come in yet. But let's just see what's going on with the S&P here. The focus has been very much on the Federal Reserve and when that first rate cut is going to come in. Obviously, we had that inflation data yesterday, which was hotter than expected, but didn't really prompt a sell-off in stocks. So the market's really shrugged off that data as well as comments from Cleveland Fed President Loretta Mester, who said that the data shows that the Fed still has more work to do. I mean, the market's sold on the fact that the next move from the Fed is going to be a rate cut. It's just a matter of when. And actually, following the hotter than expected inflation data, expectations of a March rate cut actually increased slightly, which I found interesting. But anyway, as far as this chart's concerned, we're looking for, as far as next week's concerned, keep an eye on the earnings calendar as well as US retail sales data. You know, investors are going to be wanting to see earnings growth or another quarter of earnings growth, and they're going to want to see that this big run up that we've had, these lofty valuations are indeed at least supported by some strong fundamentals in these companies. As far as the chart's concerned, again, we've seen it run up along, supported by this 20 SMA there. Did just bounce off it yesterday. On the upside, it's going to need to take out, this is the 47.95 level. If we can get above the 48.00, then it'll be looking to take out 48.20, January 22 high. On the downside, minor support here, at the 20 SMA, so around 47.50. A break below there will bring 47.25, the rising trend line support, in ahead of 47, the round number. And just because we have a few minutes left, the other one to be watching here is oil. Okay, so we've got the we've not got any major data. Sorry, what's going on there? It's Colgate. That's not what we're after, is it? Oil. There we go. We've got no major data as far as you know, oil is concerned, but watch out for what's going on in the Middle East. Obviously, tensions are rising. Geopolitical concerns are escalating. We've had the US and the UK launch missile attacks against Houthi targets in Yemen, and that's after sort of the Houthi militants have been attacking ships in the Red Sea. So yeah, there's a lot of tensions in that area, and that's being best reflected right now in the oil price, which has a sort of higher risk premium attached to it. It's not actually that supply is being affected, it's just a risk premium that we're seeing added. Oil is up around 4% today. Well, it was just before this webinar started, but we can see that here. Like, you know, we've had this push higher, it's recovered from that 69.50, where oil is suddenly driven higher above that falling trend line, testing out the 20, so that's the 50 SMA now at 74.40, something like that. Buyers are going to be looking for a rise above that level in order to test this level here, which is the 76.20, which is the December high. If we see rejection at that 50 SMA, then the one to be watching down here is the 20 SMA, which is also on the falling trend line support around that 72.50 level, which is also the November low. So, you know, that could prove to be a pretty tough nut to crack. If it does get through there, then look back towards the 69.50. But I was going to say, for now, if we can get above that 50 SMA, then I think that chart could see oil push a little bit higher. So that is all from me. If you do have any questions, then obviously do contact me, and it's been great for you to attend, and I look forward to seeing you next week.